As of this exact moment, Monday, December 8th, 2025, Bitfarms Ltd, trading under the ticker BITF, is exchanging hands at approximately $2.87 per share. The intraday action is nothing short of brutal, with the stock currently down over 15% on the session, marking a significant capitulation event that has pushed the price well below the psychological $3 support level. We are seeing a massive volume spike, with over 20 million shares already traded in the first hour, suggesting that institutional holders are potentially rotating out or that a stop-loss cascade has been triggered across major retail brokerages. If you are watching your portfolio on a platform like the Robinhood app or tracking this through Fidelity Investments, the sea of red on your screen is likely causing a visceral reaction, and that fear is exactly what we need to investigate right now. The expectation from the retail crowd, particularly those who have been following the crypto mining sector since the halving, was that late 2025 would be the golden window where efficiency upgrades and the clearing of the Riot Platform's takeover drama would allow Bitfarms to soar back toward its 52-week highs of $6.60. Investors anticipated that the integration of Stronghold Digital Mining, which closed earlier this year, would have already smoothed out the operational hiccups and that the Bitcoin price stability would provide a rising tide. However, the reality we are witnessing today creates a sharp, painful tension. Bitfarms is not trading like a high-beta Bitcoin proxy. Right now, it is trading like a distressed asset undergoing a complex identity crisis. The market is pricing in a show-me penalty, essentially telling management that the ambitious pivot to high-performance computing, or HPC, and AI workloads at the Washington site is taking too long and costing too much capital in a high-interest rate environment. The reality is that the stock is currently being compressed by a dual force: the lagging performance of the T21 miner fleet, which required derating guidance earlier this year, and a broader sector rotation where capital is fleeing mid-cap miners to chase the mega-cap tech giants. This disconnect between the easy money narrative of crypto cycles and the hard, grinding reality of industrial-scale infrastructure upgrades is where the opportunity and the danger lie. To understand why this move today is so aggressive, we have to look closely at the last few weeks of trading data. The stock had been consolidating in the low $3 range, finding temporary support around $3.15, which many technical analysts flagged as a line in the sand. Today's gap down broke that structure violently. If you look at the flow on Interactive Brokers trading terminals, you can see that the selling pressure isn't just small retail panic. There are large block orders hitting the bid, which often signals that a fund is liquidating a position or rebalancing. This creates a liquidity vacuum. When a stock like Bitfarms, which is a favorite among younger demographics who might use SoFi Invest or Robinhood crypto features, breaks the key level, the algorithmic trading bots exacerbate the move, hunting for liquidity lower down. The implied volatility in the options market has also spiked, meaning that traders are paying a massive premium for protection against further downside. This is not a quiet drift lower. This is a chaotic repricing of risk. The market is reacting to the realization that the AI narrative for miners is not an overnight switch. It requires massive capex, regulatory approvals, and time, luxuries that impatient capital is unwilling to afford Bitfarms right now, especially when Nvidia stock or Tesla stock offers immediate exposure to the same AI themes without the crypto volatility baggage. Let's shift gears to establish some common ground on what Bitfarms actually is, because the narrative has shifted significantly in 2025. Traditionally, you know Bitfarms as a pure-play Bitcoin miner. They set up massive warehouses full of ASIC computers, plug them into cheap electricity, historically hydropower in Quebec, Canada, and Paraguay, and solve cryptographic puzzles to earn Bitcoin. It's a simple spread business. If the cost to mine a Bitcoin, electricity plus hardware depreciation, is lower than the price of Bitcoin, they print money. For years, this was the entire thesis. You bought BITF because you wanted leveraged exposure to Bitcoin without dealing with cold wallets or private keys. You could just log into your Fidelity brokerage account or your Schwab Intelligent Portfolios and buy the ticker. But that business model is actively becoming obsolete, or at least insufficient. The halving event cut the rewards in half, meaning they now have to work twice as hard for the same revenue. This forced the entire industry, including Bitfarms, to look for a lifeline. That lifeline is high-performance computing, or HPC. Essentially, they are trying to take a portion of their power capacity, which is their most valuable asset, and instead of mining crypto, they want to rent that power and cooling infrastructure to AI companies who need to train large language models. This pivot is the core of the current conflict. The acquisition of Stronghold Digital Mining earlier in 2025 was supposed to accelerate this by giving Bitfarms access to power assets in Pennsylvania that are connected to the PJM grid, a massive electricity market in the U.S. The idea was brilliant on paper. Diversify away from the unpredictable political climate of Argentina and the regulatory tightness of Quebec and get a foothold in the U.S. energy market where they could pivot to AI. However, integration is messy. The market is realizing that converting a Bitcoin mining site, which essentially needs a fan and a plug, into an AI data center, which needs redundancy, humidity control, and massive bandwidth, is incredibly difficult. The news from November about the Washington site conversion targeting a December 2026 completion, a full year from now, was a cold bucket of water for investors who wanted immediate results. This delay is likely a major contributor to the selling we are seeing today. The market hates dead money, or capital that is tied up in a project that won't yield revenue for 12 months. While you might be holding Apple stock for its consistent dividends and buybacks, holding BITF right now requires a venture capital mindset. You are funding a construction project, not just a cash flow machine. Furthermore, we cannot ignore the lingering shadow of the Riot platform saga. For a large part of 2024 and early 2025, the stock was propped up by the hostile takeover attempt from Riot. It put a floor under the price because investors assumed that if BITF dropped too low, Riot would just buy them out. But with the settlement reached in late 2024, where Riot agreed to a standstill until 2026, that buyout put has evaporated. The market can no longer rely on a white knight or a hostile knight to swoop in and support the price. Bitfarms is now flying solo, and it must execute on its own merits. This removal of the M&A premium is still being digested by the market. If you are an active trader using Interactive Brokers trading tools to analyze the arbitrage spread, you would have noticed that the premium collapsed months ago. But the retail sentiment is only just catching up to the fact that Bitfarms is on its own. This realization forces a reevaluation of the valuation multiples. Without a takeover bid, does Bitfarms deserve to trade at a premium to its book value? Today's price action suggests the answer is no, at least not until they prove the Pennsylvania strategy works. Speaking of strategy, let's look closer at the operational metrics, because this is where the reality part of our thesis gets interesting. Despite the price crash, Bitfarms has actually achieved some impressive engineering feats. Their fleet efficiency has hit that 19 joules per terahash target, which is elite territory. This means their machines are burning less electricity to produce the same amount of hashing power compared to a year ago. In the brutal economics of mining, efficiency is the only hedge against a Bitcoin price drop. If Bitcoin falls, the inefficient miners go bankrupt, but the efficient ones survive. Bitfarms has aggressively upgraded its fleet, replacing old T21 units that were underperforming with newer, more efficient rigs. This is a crucial detail that casual observers miss. If you are just looking at the price on your Robinhood stock dashboard, you miss the fact that the company has fundamentally lowered its production cost per coin. They are leaner and meaner than they were in 2024. But the market is currently ignoring this operational excellence because it's fixated on the cash burn required to build the AI data centers. It's a classic case of long-term value creation clashing with short-term liquidity concerns.
Now, I want you to take a second and engage with this analysis. The debate between pure play miner versus AI infrastructure play is the most heated topic in the sector. Comment below how many shares of Bitfarms you currently hold, and tell me, are you holding because you believe in the AI pivot, or are you just waiting for Bitcoin to hit 150K? I want to see the split in the audience because it usually tells us where the capitulation point lies. Getting back to the analysis, we need to talk about the macro environment. We are in December 2025. The Fed's interest rate policy has stabilized, but rates are still relatively high compared to the zero interest rate environment of 2021. This matters for Bitfarms because they are capital intensive. They have to borrow money or dilute shareholders to buy miners and build buildings. When rates are high, debt is expensive. When the stock price is low, like it is today, equity financing is dilutive. This is the death spiral risk that bears talk about. If Bitfarms needs to raise $100 million to finish the Pennsylvania site and the stock is at $287, they have to issue roughly 35 million new shares. If the stock